if you convert that copper into pipes or wires or tubes or anything, that's going to be taxed,
Ah,
or tariffs. But it's the actual refined copper, which is, from my bottom line, is what's traded on the futures contract, is what's really the shock, and that's what really matters. That's why we've seen the biggest plunge in copper ever. Still up in the air, but just shows how expensive it was for silly reasons, and now its implications, what it means for this long-term potential enduring peak in copper in the U.S.
Mhm. So, I mean, what are the broad strokes here? How is copper, the copper market, reacting to this?
Well, it's plunge. The key thing is I look at it is, and with respect for a lot of our listeners and viewers who are traders, I'm an ex-trader. I think I probably would have lost money trading copper this year, even though I had some of the calls right, because it's been so volatile.
Mm.
But it's significant now just of where it's going and why. Copper's peak this year looks very similar to what crude oil did in 2008. It pumped up to 147, and by the end of the year is below 30. We could see the same thing in copper. Copper right now is about $4.35 a pound. The high this year was almost 6. It can easily go back down below 4 and even get to 3 on a normal correlation cycle. Partly, first of all, the key things, demand pull sources for copper are China. Now, one way to look at China as far as demand, you look at bond yields in China. 1.71 is a 10-year note yield in China right now compared to 4.35 in the U.S. That's a severe sign of deflationary forces. You look at iron ore. Iron ore is under pressure in China. And then you look at the U.S. 10-year note yield at 4.35. If you just change that to the price of copper, it's the same price as the per pound's price of copper. So there's a risk there that everything starts tilting lower now. But the key thing to remember about copper is we had such an extreme this year. That aberration between copper traded in the U.S. and copper traded in London got to 31% just this month. It's never been that high. And when you do extremes like that, the history and lessons of commodities is that's usually an enduring peak that can last forever. Crude oil's high from that in 2008. It's still there. So I'm worried now that the lessons you learn in commodities, you get a lot of pain sometimes. Markets go the direction of most pain. The most pain for copper now is probably downward and more lower.
Well, Mike, you mentioned the volatility here when we think about the copper market, but are we seeing any sort of uptick in interest from maybe institutional investors when it comes to using copper as a hedge against inflation?
Not really. The key thing to hedge about inflation is broad commodities. I've heard about some more tactical people wanting to buy copper and get on board this train for that global demand pull electrification. I've never been on board that because it's what's happening in China. It's more the bigger picture macro. The number one demand source for copper now, one of the top sources now is is solar panels. That's still increasing. But the key thing is, remember, it's known as the metal of the PhD in economics, and it's starting to plunge rapidly for good reason. The key thing I also want to point out is you look at the price of copper in London. Right now, it's in tons, 9,600 tons. The highest end of year close ever for that was about 9,800 and 2021. So my thought is to close at a new high at the end of the year is very likely. The risk is everything tilts lower. And now I'm worried that this decline in copper, industrial metals, and iron ore is showing you the tilt in the world facing tariffs towards deflation. And the one thing holding everything up is that U.S. stock market. So it might be indicating a little bit of risk there too.